Welcome to the Coin Bureau Weekly News Roundup. My name is Guy.
And my name is Jessica. Here are the top stories in crypto this week.
Crypto gains continue. Coins and tokens rally on expectations of increased liquidity as the financial system starts to strain. But why do crypto prices look like they're about to collapse?
ETH Futures Flop. The highly anticipated ETF sees a fraction of the expected inflows as institutional investors start to FUD the second largest crypto. When will ETH prove them wrong?
Real-world assets. Rising long-term interest rates increase the demand for tokenized treasuries, with almost $700 million worth issued on-chain. How this could become a problem for regulators.
Energy market concerns. Oil and natural gas starts to rise as supply shortages begin to become more apparent ahead of winter. What does this mean for the crypto market?
And a closer look at last week's top-performing cryptos and where they could be headed next.
All this and more in just a moment.
Last week, the crypto market saw a notable rally. The exact cause is hard to pinpoint, but our best guess is the expectation of an increase in liquidity in the markets, combined with a massive short squeeze, traders who bet against the market being forced to buy their positions. As for the expectation of an increase in liquidity, this seems to be coming from three places. The first is the fact that long-term interest rates in the US and elsewhere continue to rise. This means that banks are being put under stress, which could result in bailouts similar to what we saw back in March. To refresh your memory, the Fed was forced to introduce a temporary measure called the Bank Term Funding Program, or BTFP, which allows banks to borrow against their US government debt at its face value. The result was hundreds of billions of dollars being printed, and crypto seeing an epic pump as a result. As some of you may have heard, banks in the UK are starting to experience similar kinds of stress. This has likely led to expectations that the UK will have to set up a similar program to the Fed. Recall that the UK also had to intervene in its bond market last year to prevent interest rates from spiralling out of control. This ties into the second potential catalyst for an increase in liquidity, and that's long-term interest rates spiralling out of control. For context, the Fed and other central banks are not so subtly tasked with ensuring their domestic bond markets remain stable. It's safe to say that stable has not been the prevailing state as of late. In the case of the Fed, it's believed that it will intervene if long-term interest rates continue to rise at their current pace, a clearly unsustainable one if you look at the charts. However, some have argued that the Fed wants long-term interest rates to rise because it will help bring inflation back down. This relates to the third potential catalyst for an increase in liquidity, and that's the Bank of Japan. As most of you will know, the BOJ has been conducting yield curve control for years, buying up long-term government debt to keep interest rates low. This is what it did last week, and the result was an increase in liquidity. The catch is that the BOJ has also been selling US government debt for dollars to buy the Japanese yen so that it doesn't collapse from all the stimulus. This has had the practical effect of increasing long-term interest rates in the US and strengthening the USD, which is bad for risk assets like crypto. You can learn more about that dynamic using the link in the description, by the way. Anyways, the result is what you see here, a bizarre chart for BTC on the daily. At first glance, it looks like BTC is painting a bull flag that's about to fly higher. If you slap on the RSI, however, you can see the market momentum is moving in the other direction, a diversion that could signal a crash, not a rally. This diversion is even more evident on the 4-hour chart, which appears to be painting a wonky head and shoulders pattern, not a bull flag. Notice that it looks like the head and shoulders almost broke down a few days ago, but rallied back up to the support level. It looks like it could break down soon, though. This makes sense if you subscribe to the idea that ETH has been leading the crypto market of late. This certainly seems to be the case, and if it is, then the next 7 days could be rough. That's because ETH is on the brink of falling below a key zone of support around 1.6k. Next stop could be as low as 1.3k. More importantly, ETH fell to its lowest level against BTC in over a year and saw a very bearish weekly close last week. This foreshadows further downside that could see ETH test a critical zone of support around 0.05 ETH per BTC. If it breaks below this, ETH could fall way back to its 2020 lows against BTC. Now, if you're interested in trading these ebbs and flows, be sure to check out the Coin Bureau deals page. It's got up to $40,000 of bonuses on the best crypto exchanges with trading fee discounts of up to 60%. The link to that will be down in the description. Now, the key words there are against BTC. As we've mentioned before, a breakdown in ETH strength against BTC doesn't necessarily mean that its price will decline in fiat terms. However, it does suggest that interest in altcoins is waning, and this could be an indicator that the market is about to fall further. If you need evidence of that, look no further than the disappointing launch of the first Ethereum Futures ETFs. As pointed out by Bloomberg ETF analyst Eric Balchunas, the total trading volume of all Ethereum Futures ETFs was less than $2 million on the first day. Note that there were 9 ETFs in total. To put things into perspective, the first Bitcoin Futures ETF alone saw a whopping $200 million of trading volume in its first 15 minutes, 100x the amount of all 9 Ethereum Futures ETFs in their first day. The Bitcoin Futures ETF listing also perfectly marked BTC's all-time high of 69k. It should come as no surprise then that the launch of the Ethereum Futures ETF appears to have marked a local top for ETH. It seems it was a sell the news event, and it's the catalyst that caused ETH to collapse against BTC. The silver lining is that the next few months could be a good time to accumulate ETH. Not financial advice, of course. Now, fortunately or unfortunately, it looks like institutional investors are not that interested in accumulating ETH right now. Some of you might remember that crypto investment firms were signaling a decline in institutional ETH interest. Now, K33 Research is literally recommending rotating back into BTC. JP Morgan also recently published a report arguing that Ethereum has become more centralized as a result of its transition to proof of stake. This is true in some ways and untrue in others. It's arguably irrelevant, though, because institutions didn't ever seem to care about centralization in crypto. Heck, if you watched our recent video about the Bitcoin war, you'll know they've been encouraging it. Anywho, there is another silver lining to this story, and that's that the listing of an Ethereum Futures ETF has emboldened other asset managers to take things to the next level. There have already been a few spot Ethereum ETF applications filed, and now Grayscale wants to convert its Ethereum Trust into a spot ETH ETF. Now, when you consider that Grayscale recently won its case against the SEC, which had refused to approve its Bitcoin Trust to ETF conversion for unspecified reasons, an Ethereum Trust conversion does seem possible. As always, the only question is when. Well, our guess is it will only be after a spot Bitcoin ETF is approved. That said, the approval of a spot Ethereum ETF could also depend on what's happening on-chain. By now, you'll have noticed that real-world assets have been hyped a lot lately. Some would say that this has been the case since stablecoins were created, since they're technically the first real-world assets on-chain. Funnily enough, the real-world asset hype is related to the same assets that back most of the stablecoins in circulation, US bonds and treasuries, aka US government debt. According to CoinDesk, there are almost $700 million of tokenized bonds and treasuries on cryptocurrency blockchains. This number is set to rise higher now that a Swiss tokenization firm called Backed Finance has started issuing tokenized treasuries on Coinbase's Base. These tokenized treasuries will reportedly offer an eye-watering 5.25% yield, making them the perfect collateral for DeFi degens and stablecoins alike. There's just one caveat, however, and that's that you have to complete KYC to access these tokenized treasuries. As always, this means that US investors and entities are restricted from buying. However, there's nothing stopping them from, say, buying another token that's backed by such tokenized treasuries. And therein lies the concern. As amazing as these real-world assets are, they present a potential problem for regulators. If anyone can earn a yield on these tokenized treasuries directly or indirectly without completing KYC, then it could run afoul of securities laws and possibly violate sanctions. If you watched our video about Base, you'll know that there are regulatory concerns around the Layer 2 as well. For reference, part of the reason why the SEC is suing Coinbase is because it allegedly allowed users to access securities using the Coinbase wallet. Base could face similar scrutiny on similar grounds. And there are similar concerns with supposedly decentralized stablecoins like DAI. I say supposedly because DAI is mostly collateralized by real-world assets. To our understanding, a portion of the yield on these assets is being shared with DAI savers, hence why US users are banned from the Spark protocol dApp. On that note, the regulatory scrutiny could come from outside of the US as well. Consider that the EU's recently passed crypto regulations include a de facto ban on US dollar stablecoins within the bloc. It stands to reason then that the EU would place similar restrictions on what are effectively cash equivalents. That said, nobody here at the Coin Bureau is a crypto or securities lawyer, so take all of this with a grain of salt. All we know is that regulators around the world have been hostile to new kinds of technologies that disrupt the traditional financial system. Tokenized real-world assets likely fall into this bucket. Now, the good news is that reasonable regulations will eventually be passed that will make it possible for tokenized real-world assets to hit the $16 trillion market cap they're projected to have. This will be extremely bullish for the smart contract cryptos and DeFi protocols that host and leverage them. Now, the bad news is that this may not happen for some time, and in the interim, these very same smart contract cryptos and DeFi protocols could face regulatory scrutiny themselves. With a bit of luck, though, the SEC will be too distracted by other issues, like a government shutdown, for instance, to crack down on these promising crypto niches. And this brings us to our main macro concern of the moment, and that's energy prices. Oil prices have been rallying over the last few months, leading to concerns that this could result in higher inflation readings in the US and elsewhere. Obviously, that means that central banks would have to respond by raising interest rates. Now, to be fair, oil prices did have a big pullback last week, but as you can see, this pullback was right down to a zone of support around $83. If it bounces up from this level, then oil could continue to rally. We're not commodities traders, though, so we have absolutely no idea. If you do, though, drop a comment below. Anyhow, from a fundamental perspective, it is possible that oil prices could continue to rally. That's because there seems to be a shortage of oil relative to demand, and this shortage could get worse if the recent conflict in the Middle East escalates. Let's hope this doesn't happen. Given that the fundamentals haven't changed, this begs the question of why oil prices have fallen. Well, the best answer we've heard is simple seasonality. North America and Europe are in that period of the year where it's not so hot that you need air conditioning, but not so cold that you need heating. The result is that the demand for energy commodities, such as oil and gas, has fallen, but this could change when winter starts to bite. This possibility can be clearly seen on the charts for natural gas prices. Recently, they've started to perk up and could break above a key resistance level of $4. This ultimately depends on the weather, which nobody can predict with any real certainty. For what it's worth, though, last winter was Europe's warmest on record. Statistically speaking, it's unlikely to break this record 2 years in a row. This is especially because El Niño years typically result in colder winters, historically speaking. A warmer winter also doesn't mean that there won't be any cold snaps, short periods of intense cold. We saw these even during the warmest winter on record, and it seems that every winter has them. As such, the first cold snap could give us a sense of how bad the supply-demand imbalance is for gas. The bigger question for us is what impact this could have on the crypto market, if any. Well, believe it or not, but the events that unfolded last winter do give us some insight. Last December, Bitcoin miners across North America powered down due to a winter storm, and Bitcoin's hash rate fell by almost 40%. If you watched our video about when the crypto bear market bottom could be, you'll know that Bitcoin's hash rate has historically fallen around 50% during BTC bottoms. This makes sense considering that it becomes uneconomical to mine BTC when prices fall or when energy costs rise, like during a storm. This suggests that the 15k BTC price we saw last winter could have been the bottom. However, another fall in hash rate in the coming months could correspond to a double bottom. This seems intuitive given that BTC saw a de facto double top during the last cycle. It would certainly be the path of most pain. Anyway, speculation aside, a significant spike in energy prices over the winter could result in Bitcoin miners being taken offline. Whether this will correspond to a BTC bottom remains to be seen, but it's one indicator to watch closely as the cold begins to set in. If it forces central banks to raise rates, this scenario could well play out. And with all that said, it's now time to turn to last week's top-performing cryptos. So, take it away, Jessica.
Thanks, Guy, and hello, everyone. Last week's top-performing cryptos were Trust Wallet, Render Network, Bitcoin SV, Leo, and Monero. Starting with Trust Wallet. Its TWT token appears to have pumped because of an unspecified announcement that the wallet will be making in the coming days. Trust Wallet posted this on X. There is no telling what the big reveal will be. If you have any guesses, then drop them down below in the description. Now, as you can see, TWT rallied right into a wave of resistance around the dollar mark. Given that this is also a critical psychological level, it's unlikely to break through unless the big reveal is super bullish. We'll find out in the coming days. Next up, we have Render Network, whose RNDR token appears to have pumped because of a recent upgrade to the crypto project and the fact that it was mentioned in the Harvard Business Review magazine. That will probably do it. As you can see, RNDR has been in a strong uptrend since the start of the year and is showing no signs of slowing down in the short term. In the medium term, however, it could be painting a head and shoulders pattern, which could take its price lower. In this case, we'll find out in the coming weeks. As for Bitcoin SV, its BSV coin appears to have pumped because of the post by the Satoshi Nakamoto Twitter account. We'll let you do your own research about who operates that. As you can see, BSV's recent pump barely registered on the long-term price charts, but it is possible that it's forming a bottom. History suggests that it tends to see a massive pump prior to the Bitcoin halving, and it's possible that we'll see the same phenomenon again in the coming months. When it comes to Leo, it's hard to tell what caused the price of the Leo token to rally or where it's going next. That's because Leo is the exchange token for the Bitfinex crypto exchange. Bitfinex recently received $100 million of USDT from Tether, so that could have been a contributing factor. Last but not least, we have Monero, whose XMR coin appears to have pumped for unknown reasons. I mean, there was an article on Cointelegraph that explained Monero's kryptonite algorithm, but that's all that we could find. Anyway, notwithstanding the shutdown of an exchange, XMR may have found a bottom for this cycle. Note that if you do want to know why crypto projects are pumping in real time, you can join the Coin Bureau Insider Telegram group. The link will be down below.
And that is all for today's Coin Bureau Weekly Crypto Review.
If you enjoyed it then, you know what to do. Hit that like button, subscribe button, and bell icon too.
Don't forget to check out our deals page where we have massive discounts and airdrop bonuses of up to $40,000 on some of the best exchanges, only for the viewers of this channel.
You can find the link to that resource and many more in the description below.
Thank you so much for watching, and we'll see you all in next week's episode.